Breaking news, and if you are a senior, a retiree, or someone counting on Social Security, your pension, or your hard-earned savings, you need to stop what you are doing and listen very carefully, because the IRS just dropped 7 brand new tax changes that could hit your wallet, your retirement income, your bank account, and your financial future harder than anything we have seen in years. This is not a drill. This is not speculation. And this is definitely not something you can afford to ignore, because some of these changes are already in motion. Some are coming faster than you think. And if you do not know exactly what they are, how they work, and what steps you need to take right now, you could end up owing thousands more in taxes, missing out on benefits you actually qualify for, or making a simple mistake that triggers penalties you never saw coming. So stay with me through this entire video, because I am going to walk you through every single one of these 7 changes. In plain, simple English, I'm going to show you exactly how they could affect your Social Security checks, your required minimum distributions, your standard deduction, your medical expense deductions, your estate planning, and even the way your savings and investment income gets taxed. And I'm going to give you real examples and actionable steps you can take today to protect yourself and your family. But before we get into the first change, let me just say this. The government does not send you a personal invitation. When these rules shift, they do not call your house. They do not send a friendly letter explaining everything in detail. And the IRS certainly does not care if you misunderstood a new deadline or missed a new income threshold. That responsibility falls entirely on you, which is exactly why videos like this exist, and exactly why you need to hit that like button and subscribe to this channel right now, so you never miss another critical update that could save you or your loved ones from a costly financial surprise. Now let us dive straight into change number 1. And this one is huge for anyone over the age of 73 who has a traditional IRA or a 401k, because the IRS has officially updated the required minimum distribution rules again. And if you thought you understood when you had to start pulling money out, think again, because the age thresholds have shifted. The penalty for missing a distribution has been adjusted, and the way you calculate what you owe has become more complicated than ever before. Let me paint you a picture. Imagine you are 75 years old, you have been letting your retirement account grow tax-deferred for decades, and you assume you have plenty of time before you absolutely must start taking withdrawals. But under the new rules, depending on when you were born and when you actually retired, you could be required to start distributions at 73, or in some cases even earlier if you inherited an account. And if you miscalculate by even a few $100s, the penalty is no longer a slap on the wrist. It is a massive financial hit that could eat up a quarter or more of the amount you fail to withdraw. That is real money, your money, money you worked 40 or 50 years to save. And the IRS is not forgiving about it. So here is your first actionable step. If you have not already done so this year, call your financial advisor, your account custodian, or whoever manages your retirement funds, and ask them to run a brand new required minimum distribution calculation based on the most current IRS life expectancy tables and the updated age rules. Do not rely on last year's numbers. Do not guess. And do not wait until December to figure it out, because if you wait too long, you could miss the deadline and end up writing a check to the government that should have stayed in your pocket. Now, change number 2 is going to hit a lot of seniors right in the standard deduction. And this is where things get really interesting, because while the standard deduction has gone up, which sounds like good news, the way it interacts with your Social Security benefits, your pension income, and your other earnings has shifted in ways that could actually push some retirees into a higher effective tax bracket without them even realizing it. Here is what I mean. Let us say you and your spouse are both collecting Social Security. You have a small pension. Maybe you do a little part-time work to stay active and bring in extra cash. And you have always filed jointly and taken the standard deduction because it was easier and usually better than itemizing. Well, under the new rules, the threshold for how much of your Social Security becomes taxable has not kept pace with inflation the way you might expect. And with the standard deduction increase, some seniors are finding that more of their income is exposed to taxation, not less. That means the check you get from the government every month, the one you depend on for groceries, medication, and utilities, could end up being partially taxed at a rate you did not plan for. And if you are not adjusting your withholding or making estimated tax payments, you could face a nasty surprise when you file next spring. The practical advice here is simple but critical. Sit down with your most recent Social Security statement, add up all your income sources, and run the numbers through the IRS worksheet for taxable Social Security benefits using the new standard deduction amounts, or better yet, have a tax professional do it for you, because finding out now that you owe money gives you time to adjust. But finding out in April, when the bill is due, is a recipe for stress, penalties, and possibly draining your emergency fund. Change number 3 is one that almost nobody is talking about, but it could affect millions of retirees who have money in regular savings accounts, certificates of deposit, or money market funds, and that is the updated reporting requirements for interest income, and the way the IRS is now matching bank records to tax returns with far more precision than ever before. In the past, maybe you earned a few $100s in interest, the bank sent you a 1099-INT, and if it slipped through the cracks, the odds of the IRS catching it were pretty low. But those days are over, because new banking regulations and enhanced IRS technology mean that virtually every dollar of interest you earn is being reported in real time, cross-referenced with your return. And if the numbers do not match, you are getting an automated notice, and possibly an audit, without any human ever reviewing your case first. For seniors living on fixed incomes, every dollar counts, and the last thing you need is a letter from the IRS claiming you underreported income and demanding payment, plus interest and penalties. So here is what you do. Gather every single 1099-INT, 1099-DIV, and any other income document you receive, no matter how small the amount, and make absolutely sure it is reflected on your tax return. And if you use a tax preparer, do not just hand them a shoebox of papers. Go through it with them, line by line, because the cost of a small mistake is no longer worth the risk. Now, before we get to changes 4, 5, 6, and 7, which include some of the most shocking updates to retirement account catch-up contributions, estate tax exemptions, medical expense deductions, and a brand new rule that could affect how you pass money to your children and grandchildren, I want to remind you again that the tax landscape is shifting faster than most people realise, and the only way to stay ahead of it is to stay informed. So if you are finding value in this breakdown, please take a second to like this video and subscribe so we can keep bringing you the updates that matter most to your financial security. Change number 4 is a real game changer for anyone still working in their 60s or early 70s who wants to maximise their retirement savings, because the IRS has adjusted the catch-up contribution limits for 401k and IRA accounts. And while the base numbers look familiar, the new rules add a layer of complexity for higher earners that could actually limit how much extra you can put away depending on your income level. Let me make this concrete. Suppose you are 62, you got a late start on saving, and you have been counting on those catch-up contributions, the extra thousands of dollars above the standard limit, to help you build a nest egg before you retire. But under the new regulations, if your income exceeds a certain threshold, which by the way is lower than you might think, your catch-up contributions may have to go into a Roth-style account after taxes, rather than a traditional pre-tax account. That means no immediate tax deduction, which changes your entire planning strategy, your current year tax bill, and potentially your retirement tax bracket down the road. This is the kind of detail that does not make the evening news, but it can completely derail your retirement plan if you are not paying attention. So if you are still employed and over 50, call your human resources department or your plan administrator this week and ask specifically how the new catch-up rules apply to your account, your income level, and your current contribution elections, because waiting until open enrollment could cost you an entire year of optimised savings. Change number 5 brings us to medical expenses, and if you are like most seniors, healthcare costs are already eating up a bigger chunk of your budget than you ever imagined, which is why the updated rules around the medical expense deduction are so important to understand. The IRS has maintained the threshold for deducting medical expenses, but the list of what actually qualifies has been quietly expanded in some areas and restricted in others, and the documentation requirements have gotten significantly stricter. For example, certain home modifications that you might have deducted in the past, like ramps, grab bars, or bathroom renovations for accessibility, now require much more detailed proof of medical necessity. And if you cannot provide a letter from your doctor specifically linking the expense to a diagnosed condition, the IRS may disallow the deduction entirely. On the flip side, some newer expenses, like certain telehealth services and specific types of long-term care insurance premiums are now easier to claim if you know exactly how to categorize them. The bottom line is this: do not assume that what worked on last year's return will work this year. Keep every receipt, get written documentation from your healthcare providers for any expense that could be questioned, and if your total medical bills are approaching 7.5% of your adjusted gross income, which is still the threshold, start tracking everything now, because missing one legitimate deduction could cost you hundreds or even thousands in extra taxes. We are getting close to the end, but change number 6 is arguably the most emotionally charged one for seniors who care about leaving a legacy, because the estate tax exemption, the amount you can pass to your heirs without federal estate tax, has been adjusted, and while it is still historically high, the rules around portability, step up in basis, and state-level estate taxes have shifted in ways that could trap the unprepared. Let me give you a scenario that keeps estate planners up at night. You and your spouse have a house that has appreciated significantly, some investment accounts, maybe a small business or rental property, and you have always assumed that because your total estate is under the federal exemption, you do not need to worry about state taxes. But under the new rules, if you do not have the proper portability election filed when the first spouse passes away, or if your state has lowered its own exemption while the federal government made other changes, your children could end up selling assets to pay a tax bill that proper planning would have eliminated entirely. This is not about being rich, this is about being smart, and the actionable step here is non-negotiable. If you have not reviewed your will, your trust, your beneficiary designations, and your overall estate plan in the last 2 years, you need to do it now, not next year, not when you get around to it, but now, because these rules are not retroactively friendly, and the cost of procrastination gets paid by the people you love most. Finally, change number 7 is the one that ties everything together, and it is the IRS's new emphasis on enforcement, penalties, and automated compliance, which means that mistakes, oversights, and missed deadlines are no longer handled with the same leniency that many seniors remember from decades past. The penalty for underpayment of estimated taxes has increased. The failure to file penalty clock starts ticking the moment a deadline passes, with no extension filed, and the IRS's new funding and technology means they are identifying discrepancies faster and pursuing collection more aggressively than at any point in recent history. This is not meant to scare you, it is meant to prepare you, because the seniors who stay informed, who ask questions, who verify their documents, and who take action early are the ones who sleep well at night while others are opening frightening letters from the government. So here is your final action plan. Pull out your calendar and mark down every key tax deadline for the year, set reminders 2 weeks before each one, schedule a meeting with your tax professional specifically to discuss these 7 changes, review every income document and deduction before you sign your return, and talk to your family about your estate plan so everyone is on the same page. Your financial future, your retirement security, and the legacy you leave behind are too important to leave to chance. And while the government will keep changing the rules, the power to adapt, to plan, and to protect what you have worked your entire life to build is entirely in your hands. Thank you for staying with me through this entire breakdown. I know it was a lot of information, but you now have knowledge that millions of Americans do not, and that knowledge is your best defense against whatever comes next. If this video helped you understand what is at stake and what you need to do, please share it with a friend, a neighbor, or a family member who needs to hear it. Give it a thumbs up so more seniors can find it. And subscribe to this channel, because we are going to keep breaking down the updates that matter to your money, your retirement, and your peace of mind. Stay informed, stay prepared, and take care of yourself and the people you love.